Stocks are coming back with a vengeance today. The major averages exiting correction territory after yesterday's big sell-off. And that's partly due to former Vice President's surprisingly Super Tuesday. We're talking about Joe Biden, of course, predicted now giving him a roughly 80% chance of becoming the Democratic presidential nominee, while Senator Bernie Sanders' chances are dipping below 20%, and they have fallen dramatically in the past 24 hours, as you can see from the orange there on your screen. Let's bring in our market panelists, David Katz from Matrix Asset Advisors and Jack McIntyre of Brandywine Global Investment Management. Just guys want to sort of unpackage this move a little bit. David, obviously in the healthcare stocks, there's a big effect from politics, but do you think that effect is translated to the rally broadly here?
We do. Biden is clearly much better for the economy and for business and for the stock market than Bernie Sanders would be. So the fact that Bernie Sanders is less likely to win is a significant positive. You've just got a lot of cross currents going on. But in terms of the politics, absolutely last night was very good for the economy, very good for the stock market.
Well, how would you build a portfolio given, again, there's a lot of dynamics here. There's the kind of risk on, risk off related to coronavirus, risk on, risk off related to politics, David. So what, any kind of strategies that come to mind?
Yeah, we think that you're actually able to buy some great businesses with very good yields right now with very low risk, and that's what we'd focus on. As you see from the last week, it's impossible to figure this market out on a day-to-day basis. So we'd buy stocks on the big down days, and what we'd focus on in building a portfolio is really good businesses at 12 or less times earnings with a 4% better yield. Companies like a CVS or an AbbVie, we think are just wonderful businesses, and you really don't have a lot of economic risk in them. And you can get 1% in a 10-year Treasury, or you can get 4.5% on these yielding stocks. We think that's a great way to go. Wells Fargo was yielding 5%. We think that's absurd. We think the financials, which have gotten beaten up in the last 2 days on lower interest rates, are still making a lot of money. So we'd be buying those stocks as well.
Jack, has the market been acting rationally?
Oh, that's a great question, Tyler. I think it actually has. I think we're trying to sort of price in uncertainty. This is a lesson in investor psychology 101. It's fear and greed, and we are seeing fear not today in equities, but take hold. And that certainly explains why 10-year Treasury yields got down to 90 basis points. There's a lot of fear in the priced in the Treasury market right now.
Is there more money to be made moving against the market right now, Jack, than moving with it? If you understand what I'm driving at.
Yeah, I do. And actually sort of, applying the concept of value, because I think there is probably a huge, I'm going to focus on Treasuries. There's a huge disconnect between the value of Treasuries when you look at inflation versus where they are from a price standpoint. And that's the fear component. I think the fear will subside a little bit, and I think Treasury yields are going to move higher. It's not off to the races, but I think we've got kind of extreme movement in Treasuries right now that should probably be faded.
David, would you agree with that?
We absolutely do agree with that. There's no way in the world, if you are an individual, you want to be buying 10-year Treasuries right now if you have any sort of time horizon. Who would want to lock in 1% a year for the next 10 years? The flip side of that is if you can turn the volume down, not worry about the next week or month or quarter, U.S. businesses are going to continue to do well. We'd buy those businesses. You get that 4% plus yield. Historically, when you've done things like that, you've done quite well.
Jack, what have you been doing lately? Just hanging out? What have you been doing?
Well, hanging out. Well, trying not to get swept up in the day-to-day sort of emotion, which is kind of tough. Hey, We actually have been moving money outside the U.S. You've got to make assumptions in this type of world. We're looking at China as a potential roadmap. So obviously, part of the problem was a supply shock and demand shock. I think the next couple of weeks are going to be kind of critical because it looks like China is kind of getting back online, moving in that direction from a production standpoint. So that goes a long way towards alleviating the supply sort of constraint. I like some Asian FX right now that have gotten sort of beaten up. I think, and I think the general dollar, we could actually start to see it start to weaken in here.